Hi there, I'm Michael Bovee with Consumer Recovery Network, and thanks for tuning in to DebtBytes, our YouTube channel. Today, I want to talk some about the fact that when you settle debt, you could end up owing taxes. And that still surprises some people, even though it's part of disclosures that a lot of companies in the industry are required to make. And even when you're calling and talking to a debt collector, oftentimes they're going to make that disclosure as well. So what it is it's an IRS regulation that requires that if you get more than a $600 benefit from settling a debt, say you have a $5,000 account and you settle it for $2,500, you save half, so that's way over $600. If you save even $601, the creditor is going to typically send a 1099-C in January to you and to the IRS. So what that means is that if you are what's deemed technically insolvent, now this is also an IRS regulation that will help you not owe taxes on forgiven or canceled debt. So an exercise that I talk about on our website and I've gone over with our members and customers for many years is take a piece of paper and split it down the middle, and on the left hand side add up all the things that you own, your assets. Now this includes a car that you might own outright. Look it up in the Kelley Blue Book, as far as like a trade-in value type of thing. Look it up as also your 401k, your IRA, your home, and if you have equity in it, anything that you own, an asset, and the value thereof at the time that you're doing your settlements, put on the left side. Everything you owe on the right hand side. So all of the debts, all of your credit card debts, student loans, any debts that you have, put on the right hand side. Now, which number is larger? If you have more debt than what you own or assets, then you're technically insolvent. And to the degree that you're technically insolvent while you're settling credit card debt, for example, then you're not going to owe taxes on that. Obviously, you want to talk with a tax professional about any tax liability that comes from or will not result in a tax liability when you're settling debt. But that's just kind of a basic way for you to do an exercise that's going to help you determine if or when you might owe taxes. Some people, many people I've worked with over the years, don't owe any taxes on the first couple of settlements they do, but they have multiple accounts, and then as they're settling debt, they have less debt on that right hand column. Suddenly now the left hand side weighs more and they start having to owe taxes. You will pay taxes pretty much at the tax rate that you have now, unless you have a ton of debt and you're going to start settling that. But so let's assume for a moment that you're like in a 13% tax bracket, right? So as you settle debt, and let's say you ended up saving $20,000, that means at 13%, potentially you could have $2,600 tax bill come April of that following year. So be aware of that, budget for it, and know in advance. You can usually do just some quick calculations and understand if you're going to owe the tax and then really prepare for it. Because here we are in October of 2016. If I'm doing a settlement sometime in October, November, December, I want to maybe plan for that and budget and save for the taxes that I might owe January and February. Thanks for tuning in. See you on the next video.